Good morning, good afternoon, good evening to everyone. We are so happy to have you here at today's Dividend Investing Forum. Thank you so much for taking the time to join us for these conversations. We've all read the news, we're all paying attention, and as we navigate the uncertainty, to put it mildly, of current market and geopolitical volatility, it is more important now than ever to know what to pick up and what to put down when it comes to income investment philosophy to ensure that you're managing risk as successfully as possible. We hope you'll walk away from today's sessions with valuable and actionable insights to help strengthen your income investment strategy. Considering our current market events, these especially timely conversations feature an outstanding lineup of experts specializing in dividend investing over the course of 4 sessions, and we'll have a brief break after the first 2 sessions. Before we begin, some lovely housekeeping notes that we'll get out of the way. We will be recording all of today's sessions and posting replays along with full transcripts to our video hub within the next few days. Our video hub can be found at seekingalpha.com/videos. And we'll email all registrants with the link when replays are available. Throughout today's program, we invite you to join the conversations in the panel to the right of this video player. Feel free to introduce yourself, add comments in the chat, submit questions for our speakers in the Q&A, and weigh in when you see the red dot appear next to the polls icon. We have Seeking Alpha team members in the chat that you are also welcome to connect with. Of course, a few important guidelines for participating in the live Q&A and chat. We welcome all respectful discourse and ask that you please refrain from any form of harassment or inappropriate conduct. This will not be tolerated. Your video player controls, including volume bar and AI-provided closed captions in English, can be managed in the bar at the bottom of the player. If you miss anything, you can rewind to earlier in the live stream using the DVR feature by dragging your cursor to the left in the timeline bar. If you have any questions or encounter technical difficulties, please refer to the event FAQ and troubleshooting guide link posted in the chat. Now, our last note, our disclaimer for today. Past performance is no guarantee for future results. Any views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared during the event cannot be guaranteed. Content is offered for information purposes only. All event participants must comply with Seeking Alpha's events policy. Analysts, investing group leaders, and other third parties participating in the event include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Now, without further ado, let's dive into our first discussion. Is there a secret sauce for income investing? Please join me in welcoming 2 of Seeking Alpha's top investing group leaders, Stephen Bavaria of Inside the Income Factory and Rob Isbitts of Sungarden Yarp Portfolio. Stephen, Rob, thank you so much for being here today. And I am excited to get started. But before we get officially started with our session, we have a poll question to kick things off. Especially salient today is a discussion about managing our risk as investors. And so our poll question today, we'd love to hear from you. When it comes to investing, which of the following best describes your approach to managing risk? A, I prefer low risk, stable investments. B, I'm comfortable with moderate risk. Or C, I'm willing to take on high risk for higher potential returns. And there's examples in each of those questions saying what each of those would mean as far as a strategy. Now, as we start our presentation, we're going to start with Stephen Bavaria and then hear from Rob Isbitts. Both our friends from our Investing Experts podcast. Stephen was on back in July, and his episode remains one of our best engaged with, most highly loved and beloved episodes. So Stephen, even now, that episode continues to draw curiosity and a lot of interest. So I would love for us to start today's discussion with you letting our audience know what is involved, how they can get involved in the inside the income factory. And we'll start with our slide presentation. And Stephen, we'd love to hear from you how we can hear more about your income investing factory.
Well, thank you, Rena. Hello, everybody. I'll try to answer that question and tell you a little bit about the income factory. Many of you will know this and could give my talk as well as I. But yeah, if you Google the income factory or go on Seeking Alpha or Google my name, Stephen Bavaria, you'll get a number of websites and links to get to our service to read about it inside the income factory. And I think at the end of this, Rena's going to put some sort of link up as well. But anyway, the income factory is a fancy kind of cute name I came up with 10, 12 years ago to describe our approach to investing, which is kind of like when Ford Motor Company builds a plant. It doesn't worry about the value of the plant from week to week, month to month. It focuses on how to increase the output of that plant. And we look at our investment portfolio as kind of like a factory whose job is to produce cash income over time and to build that cash income, create our own growth through compounding and reinvesting that cash. Now, one of the things that we learn often before we become income factory investors, either through reading it or our own experience, is that the average investor cannot beat the equity average. The equity average over the last 100 years or so, 9 or 10%, that's the average equity return. It wouldn't be the average if a majority of people could beat it, obviously. But more than that, most investors who attempt to beat it actually do worse than the average because they fail to sort of hang tough through tough markets. And they try to time the market or hedge or balance their portfolio, often with lower earning assets. And so they end up not even achieving the average. So as the next slide will show, successful investing and meeting that equity average is simple in theory. But a lot of us find out it's not in practice because, as Nobel Prize winners and others have shown over the years, John Bogle built a business around it at Vanguard. You have to stick to it religiously. You got to invest in an index fund or then a whole market type of, well-diversified fund and stick with it for years. Rip Van Winkle would have been a great investor, but it's hard, as our next slide will show. It's hard for the average person to always do this. I mean, some people have the patience, and can stick with it over time. But the average stock only yields 1 or 2%. The S&P 500 yields about 1.5%. So to make your 9 or 10% on average over time, you're counting on a capital gain of 7 or 8% a year on average. And as we know, the market goes up and down and all over the place. And it's very hard during the down years to stick to your guns and not be tempted to do something, whether it's hedge, go to cash, try to find, say, I'm going to go out of the market and come back in at the right time. Well, it's like a train leaving the station and you're on the platform, except in the market, there's no conductor to blow the whistle and say, hey, let's get back on the train. So you make a few timing mistakes over the course of your investing life and you can, never catch up. So what we do, Rena, yeah, thanks. We use high yield assets to create our own growth, where total return that, we get our 9 or 10% total return, but mostly through cash income. We're not dependent on the capital gains. I mean, it's nice if you get them once in a while, but we invest in the sort of things, corporate loans, high yield bonds, utility stocks, things that create high dividend yields through interest payments or high dividends that continue pretty much as, I call it, business as usual income. The accountants call it net investment income, but it continues regardless of what the price of the asset does. So while traditional growth and investors are collecting tiny yields and worrying about volatility, income factory investors, while we still have risks, and we'll talk about that in a second, we have a more stable source of cash income generally through all sorts of markets. And frankly, it does help you sleep a little better, as thousands of my colleagues or readers and members have told me. Let's move on, Rena. Thanks. We introduced this idea about 10 years ago. It was called a heresy by many, but basic math basically prevailed. Total return is cash yield plus gains, capital gains and losses. And it doesn't matter which you have, 10% yield can, 10% return can be a combination of any of that. And now 10 years later, after people have accepted the idea that you don't need growth in order to grow your wealth, we've got, 18,000 followers. Our Inside the Income Factory service is number 4, which amazes me, having started it 4 years ago, not expecting anything like this. We're number 4 out of 141 investment services here on Seeking Alpha. And the McGraw-Hill published my book about it a few years ago. So we've caught on, and I'm happy to say a lot of my readers and members on Seeking Alpha and elsewhere now send me the most wonderful messages and say, hey, I'm bringing my sons and daughters and friends in. I'm telling them about it, and and it's kind of like a wonderful community that seems to have found an alternative approach. What have we got next on the next slide here? The risks. It's often credit versus equity, and credit risk is an existential risk. Equity risk is a risk that the company or the fund or whatever won't just keep on paying its debts, but will grow. So when you invest in credit or high utility stocks, you're betting on people continuing to do what they've always done and just kind of staying alive and muddling through. But with equity investments, you're betting on they're not only doing all of that, but growing their business as well. So it's like a horse race where with credit and income factory investments, it's like betting on the horse to merely survive and finish the race. Whereas with credit, it's an easier bet to win. I mean, with equity, it's a much harder bet to win because you're betting they'll do all of that, but also grow. So anyway, I think we got another slide or two. I'm probably running out of time. Tell me when I have.
You're good. You got a couple more.
So the income strategy, factory strategy is not for everybody. And we don't claim it's better than an equity growth strategy. If that works for you and you've got the patience and the determination to stick with it, then go with an index approach or an equity growth approach. But our income factory, for many of us who are not as brave, we thought we were until we hit some really hard markets over my lifetime. But it's hard to stay the course. But with an income factory where you're getting your 9-10%, and in fact, when the market goes down, you grow your income even faster because you're reinvesting. If you're in an accumulative mode, you're reinvesting your dividends, your high distributions in new machines for your factory, so to speak. But they're at bargain prices because the market prices are down. Now, if you're retired, I mean, if you're 60 or 70 and you're retired, you still have to have a growth outlook because you might live till you're 80 or 90 and will still need, your income to grow. But you could take out, say, 5, 6, 7% or whatever you need to take out to retire on, and you don't have to sell capital. You avoid that sequencing risk they talk about. If the market's down in a particular year and you're dependent on that for your retirement, then you got to sell at whatever those prices are and destroy capital to take out your retirement, the pension you're paying yourself. With an income factory, you're selling, as I call it, business as usual income, net investment income. So you're not touching the principal. So the principal may be up or down in a particular year, but you're just living off the income from it. And that's really comforting. So there we are. That's the that's my book for those that are interested in learning more. And we'd love to get your questions and see you on our Inside the Income Factory service as well, where you can try it out for 2 weeks, get a free trial if you like. It may not be for you, but you can find that out before you're committed. So thanks very much, Rena, and everybody.
Thank you, Stephen. And I think even for people that may not be convinced, there's a lot of compelling insight to be had from Stephen's philosophy and strategy. Speaking of salient insights, one of our BFFs of Seeking Alpha, of our Investing Experts podcast, none other than Rob Isbitts, who runs Sungarden Investment Publishing. Sungarden Yarp Portfolio is his investing group. Rob, take it away. Share with people your sundry insights about income investing.
Sure. Great to be here and right back at you, Rena. Steve, great to be with you too. Looking forward to the Q&A in a few minutes. You're a tough act to follow, you know. And I'll also second what you said about being not that brave. I think those are the investors that tend to survive. So when I first heard we were going to be talking about the secret sauce of income investing, I thought of two things. One you're all familiar with, one that's a little more obscure. The secret sauce reference everyone knows, of course, is McDonald's. The other is a 1982 film called Fast Times at Ridgemont High. It's a classic for those of us who grew up around that time. So if you do remember that one, let me know in the chat so I'm not alone there. I cannot hear secret sauce without thinking about that. I can also not think of a better moment in our lives, frankly, to be talking about what I've spent decades doing. That's investing with risk management as the very top priority. I call it ABL, avoid big loss, then try to make as much as you freaking can. I am now one of more than 100 investing group leaders at Seeking Alpha, but I'm also the newest or one of the newest. So allow me to fill in some blanks about how I see investing, then we'll narrow it down a bit. I've been at it for about 40 years. I've made a ton of mistakes. I've learned from them, and I kept evolving my approach and tried to stay humble the whole time. It worked out pretty well, so let's get into that. Investing works in this way. There are 5 critical steps for investors, but I think a lot of them skip the first 4. There's philosophy, finding one. Can be mine, can be Steve's, can be anybody else's, but to have one. Develop a process around it. Thank you. Develop a strategy under that process. Create a portfolio, not just picks, and then the tactics to rotate through and whatever mechanism that is. It can be high turnover, low turnover, in between. But then at the bottom, the base of the pyramid, if you will, is risk management. It underlies all of it. It's an often ignored concept, and it's not nearly as exciting as investing into what's hot or clinging to the old way of owning dividend stocks. But I do think there's an evolution going on for we do-it-yourself investors. And so I want to talk about that now. Next slide, please. So I am a baby boomer, barely. I was born in 1964. And while much of my career was spent managing other people's money as an advisor and a fund manager, I'm semi-retired, like a lot in the Seeking Alpha audience. So now I guess I'm the client, right? Every chance I get, I try to remind my baby boomer peers and everybody else that if this, what you're looking at here, which is 2000 to about 2011, if that had been the first 10 years of our retirement, we might be more focused on risk management. That was not only a lost decade where the S&P 500 did nothing. Think about it. We are 25 years into this century, and half of that time the S&P went nowhere, and dividend stocks have done worse. And that has implications for what I'm going to talk about in the next few minutes. There's a lot of hype. Risk still exists and it needs to be managed. And so this is how weird these times are for investors. This slide shows it very well. I feel like a lot of people have already forgotten that most stocks spent a lot of 2023 and 2024 just digging out from the mess of 22 and higher rates and falling stock prices, eventually recovered toward the end of the year, and then we had this roaring narrow bull market. But when you look back at it now, the last 3 years, 30% of the stocks in the S&P 500 are flat or down, 30%. And that's in a bull market, right? So it's a little bit deceiving. Over the last 5 years, it says there, eight stocks have accounted for more than half the S&P's gains. And they were not yield stocks, my friends. They were growth stocks. This is why I like to have what I call a balanced diet when it comes to investing. Everybody knows how to play offense. Read articles about it constantly. Very few understand truly how to play defense. And that has been my priority approach for over 30 years. I think people forget about this because they haven't had to do it for more than short periods of time. But if you remember anywhere from 1987, which I went through as rookie in the business, to dot-com bubble, et cetera. And I'm not trying to be a gloom doomer. I'm just saying, don't forget about risk management. So my approach is first defend unruly markets, then exploit them, and then try to make as much as I can at all times. And that involves using a lot of flexibility in the process. I've been doing that for over 30 years. I'm not going to stop now. So let's move on to the evolution that I see on income investing. So investing in dividend stocks used to be, buy great businesses and hold on to them. And that still works, but not like it used to. So here are some of my top line beliefs, if you will. The post-pandemic markets are just entirely different. So many different ways I can show that to you. These indifferent players, algorithms, passive flows, option traders, and I use a lot of options in my work, but particularly the first two, the algos and the passive flow, the index funds, ask me about that if you don't know what that means, changes the way markets work. The dividend yield, the S&P 500 has been cut in half in the last 9 years. Companies are buying back more stock. It just changes how we look at yield stocks. They're not really put on a pedestal anymore. We've had so many former solid yielders that just aren't anymore. The sustained moves in dividend stocks as opposed to the Mag 7, very tough to come by. They go up, they come right back down, and you're left with maybe your dividend. That's why so many stocks are flat for 3 years. A lot of big price drops, even on high quality, high dividend companies, especially when their earnings hit. T-bill rates are still competitive, still can be sliding a little bit recently, but they're still way above where they were. So that's a good competitive factor. And I do think there is a level of complacency that frankly is off the charts now, and I think it demands something fresh. So let me give you a quick snapshot of what the Sungarden Yarp portfolio looks like. It really is divided into several silos, but let me just walk through this quick visual. This is what I call the how in the investment process. First, we figure out what stocks or ETFs we're willing to own at a price. I call that a watch list. Then there's when we want to own it and when certain ones should be prioritized over others. I use a sports term called a depth chart to describe that. And for me, it's a lot of technical analysis. I'm a big fan of the Seeking Alpha Quant factor grades, and ultimately, after the how, I should say the what and the when comes the how, and that can be ETFs, it can be options, it can be a combination, whatever gets the job done. As my subscribers know, I'm not really big on style points. I'm about winning and not losing big. And look, there's a lot in here, but the key again is ABL, avoid big loss and make as much as I can. So now I'm going to just briefly introduce two parts of this. So quick story on what we call yield at a reasonable price, or YARP dividend. It is an investment factor. And about 8 years ago, my son, who was then in college, now is in a different part of this industry, I'm happy to say, he was one of our summer interns, and I asked him a question that I think every kid would like to hear from their parents. I said, go back over the last decade, look at all my stock selections, and tell me everything I screwed up. 2 months later, YARP was created, yield at a reasonable price. So a quick visual of how it works, and then we can get to more in the chat if we like, in the Q&A. This is a chart of one stock, familiar to a lot of Seeking Alpha readers. It's the monthly dividend REIT, O, Realty Income. But I could put any stock up here, it would work the same way. As long as it yields at least maybe 2% these days, the analysis would be the same. So Yarp is a process, and it's the first part of what I try to do on the stock end, non-ETF and perhaps including options. But it works for ETFs as well. The top part of the chart there, what you see is the price, including dividends, going back 10 years. The bottom shows the dividend yield history. If you read my articles in Seeking Alpha, you've seen a bunch of these. What I drew in green is the same situation that has happened with this particular stock, just an example. It's happened 5 times in 10 years. What happened? The dividend yield peaked and started to decline. And that's what you see in the lower part there where I have circled it. It didn't decline for just a few days, but for maybe 1 to 3 months, enough to signal to me that the yield had peaked for a while. When a stock peaks, that normally means the price is bottoming. In the so the upper part of the chart, I mean, you can see how it worked out with those arrows pointing to when those were, let's call it high percentage shots, okay? Layups instead of 3-pointers or half court shots. Doesn't work every time, it's not a guarantee, but this is sort of the kernel of my not so secret sauce of income investing. So if we go to the next slide, this is why it is no longer a secret sauce anymore. It is a trademarked dividend ratio that started, with what I worked on with my son 8 years ago. And, all of the features of this research and an index that was created around it by a company called Syntax, you see there, the Yarp 50 index, I mean, brand new, just released. That is, at this point, what you're looking at there is 6 very big dividend yield ETFs that I'd be shocked if a lot of people in the audience didn't own or certainly know about. Those 6 combined have almost 300 billion in assets. Yet since the beginning of, let's call it the post-pandemic era, 2021, the Yarp index, and granted, it's an index, okay, and it's back tested, but there's a pretty big spread there. So that tells me that there is something, and this has always been the case, but it tells me that, especially in modern markets, there's something to this. And so, of course, there's no Yarp ETF. The only place it lives now is with the new investing group that was created at Seeking Alpha. I'm going to go through one more aspect very quickly, and then I think we'll get to the questions. It's a comeback story. I was managing client portfolios in a hedged mutual fund back in 2007. And then we had Bear Stearns and Lehman. Well, around the time of Bear Stearns, I said, you know what, I'll own stocks, but I need some coverage. And I insisted on putting an option collar around everything I owned. And the modern version of it, which I brought back recently for subscribers and is getting a lot of great comments on the articles I write about this, and certainly the investment group seems to really like it. I call it the dog collar, and it's as simple as, if you look at the next slide there, find out of favor companies, dogs, if you will, a decent long-term chart pattern, buy at least 100 shares because it has to be optionable, and make sure the options are liquid. And the next slide, I won't go through this, but is there if we want to go back through the details and get some questions. It's a stock purchase. It's a covered call right, which a lot of people are familiar with, and there's ETFs that do it. But the put purchase is what seals the deal for me because it defines your downside risk before anything happens to the stock. So I'm going to stop there. I have a recent example from my live portfolio for the Q&A. We also do a subscriber session for every Monday at 4 p.m. This Monday's session, March 10th, we're going to make it open to the public, other folks at Seeking Alpha who want to join us, and I'll kind of do a longer form version of what I started to cover here today. And that's us on Seeking Alpha.
Awesome. Thank you, Rob. Appreciate it very much. And again, it's inside the Income Factory and Sungarden Yarp portfolio. If you want to find out more, I would like to take us back to our poll question and let us see where we landed there. First of all, I want to make sure that everybody knows to look into our chat room for any questions that they may want to ask. And I am having some technical difficulties, so just give me 1 second. But we have okay, so we have our poll question, and we are getting to that right now. Apologies. Okay, so our poll question, when it comes to managing risk, which of the following best describes your approach to managing risk? And at 63%, it's B, I'm comfortable with moderate risk. And at 32%, C, I'm willing to take on high risk for higher potential returns. Getting to the questions, let's see. Albert asked, what are key metrics you look for to get a sense of dividend sustainability? Robin, Steve?
That's a good, obviously an essential question. I look primarily at the record of the fund. I look at what the dividend has been over time. I look at whether the dividend, whether the earnings of the fund cover that dividend, and especially I'll look over time at whether how well they cover it, because ideally the gold standard would be to have the net investment income. That's the cash income received every year as interest or dividends by a fund cover the dividend totally. I mean, that's great if you can achieve it. A lot of credit funds will, because then you're not dependent on capital gains. But if you're talking equity type funds, then of course you're going to have to include capital gains because that's an important part of their total return. But even there with a fund, you want to look back in time and see how well their total return has covered their dividend. And and especially in the last year or so, because times change. But I look at those factors, and then also the quality of the management. I like funds that are run by people that are, if they're credit funds, great credit shops, or really, highly experienced management shops.
Rob, anything to add there?
Yeah, for sure. I mean, that was a great fundamental answer from a great fundamental analyst, Steve. Mine is a little bit less traditional, if you will. My dad taught me to chart stocks with graph paper and pencil when I was 16, 1980. And I've been a technician and a quant, not a fundamental analyst. And so the way I approach that question, dividend sustainability, is a few different ways. One, it's not going to bite me if I own a put option underneath it, because there's a limit. I've defined the limit to how much that stock can fall and hurt me. So that's one way to take that out of the equation. However, you also don't want that to happen. And so, I mean, look, part of what goes into Yarp in the dividend history, we've tested it so much that if a dividend is going to be in trouble, we will see it. In fact, and not every time, but one of the aspects of Yarp is when a dividend yield has gone through the roof. Some people would say, oh, it's cheap. Look, it's selling for 6% yield. This thing used to be at 3 or 4, and now it's at 6 or 7 or 8. And I look at that and I say, wait a minute, until the yield has topped out, that's what Yarp's all about. Until the yield is topped out, it's what I would call high risk, high reward. Could be a bottom, maybe not. And look, also the technical analysis that I do, I believe that most of the fundamental information is in the stocks, and we let the market tell us a story, and that's through the charts. And so, if I see a chart that looks like it's breaking, kind of like the whole market right now, then that will be a red flag for me. So, and I also do use the Seeking Alpha quant grades. I use the dividend safety ratings. I use the profitability grade a lot. And so it's a variety of things that go into there.
Very good. Stephen, Joe is asking, what's a good dividend growth ETF to consider?
Well, dividend growth ETFs, you're probably talking about stocks with good dividend growth, which are not, I actually don't look too much at that. I know Schwab and Vanguard and, have some basic ones, some of which are actually included on Rob's charts, I think. I don't buy those kinds of funds particularly because the yields just aren't high enough to meet an income factory standard. I'm looking for yields of 7, 8, 9, 10% and more. More likely 8, 9, 8, 9, 10% and more. Seldom a few sevens. So those kinds of dividend growth stocks would more likely have lower dividends, but be consistently growing them over time. They're a great investment, but they're not income factory investments.
Well, Rob, you're an ETF guy. What would you say to that question?
Yeah, well, frankly, and maybe I'm a little biased here, but part of the reason I've angled the Sungarden Yarp portfolio service toward what it is and incorporating the options and all that is because I think that dividend ETFs, which I have studied for years, I'm 30 years into my ETF career only because they've only been around for about 30 years. I see more risk than reward, at least in the coming couple of years. And a lot of that is because dividend growth is only as good as the ability of the stocks to go up. And I think there's more downside risk. There's always upside, always upside. And look, I mean, a couple that I can tell you, I mean, the one that I've tracked the most and used back when I was running kind of ETF only portfolios before I kind of evolved, as I was saying before, was NOBL, ProShares S&P 500 Aristocrats ETF. But it was my growing dissatisfaction with ETFs like that, the usual suspects, if you will, in the dividend ETF crowd, that made me say, you know what, I might invest in those underlying stocks. I might invest in ETFs that pursue higher yield, but I'm going to do it tactically and, as they say, not without a net.
Very good. We probably only have time for one more question. We've got about a minute left. How to treat or prefer ordinary dividends versus qualified dividends? Let's do like 25 seconds each. Stephen, go for it.
Well, ordinary dividends, which tend to be in credit funds, which have the highest dividends and are the ones I focus on the most. They're mostly going to be ordinary dividends, which are not qualified because they're based on interest and not corporate dividends. So they are best used in an IRA or a deferred account. In our taxable model, we have a lot more funds that pay qualified dividends, or even better yet, return on capital, which is not a negative as so many people seem to naively think it is. MLPs and many other funds that don't realize their capital gains because they keep their winners and keep on winning with them year after year, which then means that part of their total return is called return on capital and it's not taxable. It's deferred until you sell the asset. So that's the difference. Qualified dividends they work best in taxable accounts, but you can get higher yields in deferred accounts that use credit funds and other things.
Thank you, Stephen. Rob, we're not going to be able to get to your answer. I apologize, but reach out to Rob and Stephen and their investing groups, chat with them, use their resources. Rob and Steve, thank you so much for joining us today and sharing so many insights and your valuable perspectives and strategies. Really appreciate it. Next up is the value of dividend growth investing, featuring Dividendology, a sought-after analyst on both Seeking Alpha and YouTube. He is going to share tips on how to buy quality stocks at great prices Eli will break down why dividend growth investing has proven to be one of the most effective forms of investing. Thank you again for joining us. Handing it over to my glorious colleague, Julie Morgan, host of Seeking Alpha's Wall Street Breakfast podcast. Take it away, Julie. Thank you.